So, very good morning, very good afternoon, everyone. Yeah, this side, your tutor, Chartered Accountant Ashwini Bhanushali for APM. Yes. So, students, I hope the revision series which we are going ahead is going to be very helpful for you all. So, I just need to know whether we are live or not. Just give me a minute so that I can cross verify it more better. So, just give me a minute. So, yeah, I think we are live. I'm just figuring it out for once. Yeah. Yeah. This side, so yes, we are live. Okay. Now we can just start it. So students, if you remember in the last session, which we were doing about budgeting and control, we have covered a lot of concepts regarding what is budgeting and control. We have dealt with some methods of budgeting and we have started with some questions, which I told you becomes important, which are about variances. So yes, students will be winding it up with the variances and moving ahead with the transfer pricing concepts also. So without any further delay, let's just start with the concepts, okay? So I'm just opening with the Excel sheet, which will be very helpful for us because we are going to solve a lot of questions. So if you remember students, we have started with this question about the material variances, which was about variances. So what is the variance? What is the basic meaning of variance? Okay. If I talk to you about the basic meaning of variance is the difference. Means I'll just try to denote it over here. What I budgeted on day one and what I actually get at the year end, okay, may not be same. What I thought maybe could be different and what it actually happened could be different. Let's say, for example, considering material as a perspective, okay. Consider the material as a perspective. Material, okay, material. Like, for example, the company needs a raw material. Okay, raw material. So if the company needs a raw material, on day one, they will think like what kgs of raw material they want. They'll think for the whole year maybe. They'll think at what price the material would want. And yeah, that was with the one. And at the year end, they'll see the actual kgs. They'll see the actual price and yeah, they'll get the cost. So let's say I thought like on day one, I'll require 500 kgs of raw material at a price of 50. So maybe I can expect a 500 into 50, which is around $25,000 will be my expenditure. Okay, this is my cost in dollars will be my expenditure. But what eventually happened? Is it the same? What actually you thought it and what actually happened was? So let's say, for example, if I just figured it out, yeah, this is my actual stuff. I'm putting my actual stuff with black, so yeah, it is clearly evident for us. Okay, yeah, okay. So what I thought, guys, actually I required not 500 kgs, I require 620 kgs and the prices was 60. Oh my god, so 620 into 60. So I got to know my expenditure turned around to be 37,200. So you will say, looking at this picture, okay, ma'am, like what I thought on day one about the cost and what it actually incurred is different. Yeah, so there is some variance. So if I see about the positive variance or negative variance, it is clear cut that what you thought was the cost, but what it actually incurred is more. So it's something negative. So if I ask you, just tell me what is the variance? What's the difference? So you can give me easily. So you'll say, okay, ma'am, please reduce 37,200 and get the difference of 25,000. So ma'am, that will be your adverse variance. So if I say, you'll say, ma'am, so easy it is. But you know what? 12,200 to anybody can get it. But over here, we are not just restricted to find out the variance amount. No, students. Over here, we'll be getting the marks on analysis. Like, why is this variance occurred? So when it is a production department or the purchase department or the material department, there are two departments involved in it. So once there will be a production department, at one stage there will be a purchase department. So when it is production department, the production department will be liable for the kgs of production, like how many kgs they want, what is the quantity they want, right? And when it is a purchase department, they'll be figuring it out at what price they want to purchase and so on. So when there is a difference because of the material usage, guys, it is basically because of material variance. That is over here. If there is a difference, try to please understand. If there is a difference between these kg and these kg, it is a problem of whose? It's a problem which is known as material usage. So yes, the usage is more. And what if I say you the prices? There is a difference of prices. Yeah, you wanted 50, but actually it went to 60. Yes, ma'am, there is also a difference. So whatever I have turned up with pink is a price variance and whatever with yellow, it is a material usage variance. I know you guys must not be having any doubts because this is a stuff that we have already covered up in the question. So if you don't understand this, don't worry, we'll be solving it. One more question for labor variance. It is the same. So maybe you can get it more clear. Okay, this is what I have already framed the question for you. So that will eventually be easy for us. Okay, so without having any further delay, let's just assume and try to like correlate a lot of concepts. Okay, so yeah, without any further delay, let's just start. So what is basically the meaning of labor? See, whenever there is a production, there is a clear-cut situation that we need labor to work on it. Yes. So we are in the need of laborers. So laborers are the utmost position who are going to work and who are going to cater all the needs. Yeah. For example, I know that to produce one unit, maybe one labor hour can be required. Like 1 hour is required. Maybe a labor takes 5 hours or whatever it is. It is assumed on day one that one labor may be requiring, let's say, 2 hours to complete one unit. And the price per labor I need to give is 3. So maybe this could be my cost. Okay, maybe this could be my cost. Yeah, 2 hours, 3 and 6 could be my cost. This could be a situation if I thought, okay, like, Baba, there is only one unit, I want to produce it. But actually what happened? Actually you produce 500 units. If I produce actually 500 units, these are the actual hours, price and cost which is required. So we'll assume it. We will make a revised standard, and this is very important. We have to make the revised standard or revised budget. Okay, considering the number of units. If I consider the number of units, let's say for one unit you require 2 hours, definitely for 500 units, I require 1000 hours. Okay, prices will be exactly what it is. So if I just multiply it, I'll get how much? Okay, so I budgeted that as per my budget, so yes, students. So I budgeted. When I made the budget, I thought, okay, it should be eventually 3000 as a cost. But allegedly it went to 3500, which is not good, right? It's an adverse. Adverse by how much? 500. Yes. So we take into account like that 3000 minus 3500. So you say, okay, ma'am, it's a 500 adverse. So yeah, 500 is adverse. Now tell me, whom will you scold? Will you scold the efficiency of the labor? Yeah, okay, you were supposed to take this much hours, but you took more, you are not efficient. Arey, so they'll say, okay, no, ma'am, 1000 hours were required and he already took 1000 hours only. So there is no problem in his efficiency is cool, perfect, efficiency is perfect. But when you see the prices, it should eventually be 3, but now it is 3.5. So there is a problem in price variance. So this labor variance, you have to understand it in the price variance. So what's the price? I thought like my budgeted price was 3 and actually price was 3.5. So ma'am, there is a problem of how much? Yes, 3.5. So different of 0.5, which needs to be multiplied with how much hours? Exactly 1000 hours. So if I take up the total, am I getting this? Yes. Is it 500? Yes, guys. So this is what we have to just analyze it, and this is how we normally calculate it. I hope we are doing it very well and very easy. This is all what we have did it in the yesterday's class also. It's just a revisionary portion we are going ahead with. Okay. Let's say about the standard budget, the revised and the actual budget of, let's say over here there are 1 unit, over here 500 units, and over here also there is, let's say, 500 units. For, let's say, 1 unit I require 2 hours. So for 500 obviously I'll require 1000 hours. Prices will be 3. So if I just multiply it, it will be 3000 for sure. So when the people require 3000 as a cost, and actually it's just 2700, it's good, na? It's good. It's known as favorable. So you incurred less cost. How much is the favorable? So this 3000 minus 2700 is favorable. Now if it is favorable, people are happy with it. So you have to praise someone. Like it's not like always scolding people. You have to also praise someone. Okay, wow, you did a great job. You should continue doing the same. So whom will you praise? Will you praise the price people? So their price will be the same. So no price. But if you see the efficiency, where initially we have increased the efficiency, where initially it used to take 1000 hours, now we have did it in 900 hours. So 100 hours are reduced. Agreed? So 100 hours are reduced. So 100 hours into price of 3. That means it comes around to be a favorable of 300. I hope you guys getting it. Yes, very easy. See, I'm going fast because I know these are the concepts which are assumed. Okay, but you must be knowing it. Yeah. Up next, when you take up the third question, now this becomes important because it is not just one material which is going to change. Sorry, which is not just the efficiency which is going to change. The efficiency and price both can be changed also. So yeah, let's see what happened over here in this question. If you see this third question, yeah, for your one unit required 2 hours three. It's the same. Okay, for 500 unit it is the same. So what is the revised budget for 500 units? Okay, so I can find it out. So let's say for 1 unit, I require, let's say, 2 hours. So for 500 units, definitely I'll require 1,000 hours. The price will be exactly what I thought on day one. So my cost needs to be 3,000. What is for sure? Yeah, this is my cost, which I estimated it. Okay, which I like not estimated, which I made a revised budget of. Okay, I just made a budget for. Okay, I made the budget for. But actually, it went to 3420. So you will say, ma'am, it's wrong. It's loss. Yeah, where it should be 3,000, actually your cost turned around to be 3420. So it's an adverse 420. So if you are having an extra cost of 420, so who is liable for incurring this extra cost? Is it something the efficiency of the labor or is it something the price? Yeah. So if I see the efficiency, I just need to know like whether the employee is efficient. So if you see yes, 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 ma'am, you will say, ma'am, just to see, just think and say, yeah, where my employee initially used to take 1,000 hours, now he's taking only 900 hours. So it's good. It's good. So he has made his efficiency more. So please take my budgeted hours were 1,000. The actual hours were 900. So it's good now. It's good. It's positive. It's favorable. Favorable by 100. But multiplied by what price? So will you give them the rate of 3.8? So you'll say, no, ma'am, whatever I thought of was original rate. Original was 3 rupees or $3. So this much amount is nothing other than favorable. Then why is there a difference? Why is there a loss? So if you see one function over here, if you see one thing, it is a clear-cut indication that the price what you thought you will pay is 3, but actually you paid 3.8, which is 0.8 you paid extra. It's a loss. So what I paid by budgeted price was 3. Yeah, I made an extra payment of 3.8. So obviously I'm having a loss of zero point 0.8 into how many actual hours I took, 900 hours. If you multiply it, this much is your adverse situation. So if you take adverse and favorable, so it's minus 720 plus 300. So it gives you a negative 420, which is what we got it over here also. 420. Yes, and 420. I hope you guys are getting it. Yes, I'm so clear, pretty clear. Yeah. Is it this 420? Yes. Am I getting it over here also 420? Yeah, clear? Yeah. Super easy, 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 easy. This is what people have to understand it. And what we did it is known as on day one doing creating the budgets and at year end analyzing the budgets whether it is perfect or not. Okay. So after completing this, and this is something which is expected and which is known as standard costing. Standard costing. Now we come up to the important topic, which is very, very, very important. Okay, which is very, very important, which is this variances. So if I see this, you may be feeling like, ma'am, what it is? It is so difficult and like, ma'am, it's very, very, very clumsy. No, I'll try to explain you to the best possible way, and I am so pretty sure that you will understand it so easily. Okay, I'll just close it. Definitely. Yeah, I'll not save it this time. Okay, I'll just try to open it up one thing, and that is what is very, very easy for you guys to understand it. Unless until you get the concepts, if you understand the concepts, then the questions are like a crisps. Like it will be very easy. Okay. So without having any further delay, let's just understand one concept and then we will do with the questions. Now I think like the PPT is visible or not. Yeah, the PowerPoint is visible. I'll just make it very big. So if you remember, we were at this position. We have already completed a lot of stuff in the prior classes. All the ZBVs and everything was completed. Okay, we were doing with the variances, if you remember. So yeah, we were having two types of variances, which is known as, okay, planning variance and operational variance. If you know these two words, we have planning variance, we have operational variance. So for example, if I tell you, see, on day one, I made the budget. On day one, I made the budget. I made the budget, okay, Baba. Let's say to manufacture 1 kgs of, so let's say to manufacture 1 unit of toy, 1 unit of toy, 1 unit of toy, I require how much kgs? Let's say I told, okay, I require 2 kgs of raw material of plastics and all. The price if I get is, let's say 2 kgs of raw material, I get it in the market at the rate of, let's say per kg I get it at the rate of, let's say 5. So maybe my cost to manufacture is, let's say 10. Yeah, is it clear till 1? This is your budget which you thought. What happened actually? Actually, when you saw, you required raw material, prices and the cost for sure. Let's say you required 4 kgs of raw material, oh my god, to produce 1 unit. Okay, okay. The prices were 2.5. Seriously, 4 into 2.5. Okay, I'll not put 2.5 for sure. Let me put it 3.5. 3.5. 4 into 3.5. So you'll say, ma'am, it's 14, right? So if I just show you this. So what up till now we were doing now, until now what we were doing, the concepts we were doing till here only. Means what we were doing it, we were analyzing this stuff. Yeah, we were analyzing this stuff. We were considering the kgs, we were considering the prices, and we were considering the cost. If I'm talking to you about the normal traditional method, what we used to do in the normal traditional method is we used to scold. And now considering this 14, I thought like, no, they are taking up more price. It's better. Like we will tell them, okay, no, you have like increased a lot of price. You have to like reduce it. So if I just see this, I feel like, no, ma'am, they have taken up a lot of price over here. Instead, what they can purchase it at 10, they have purchased it for 14. Okay, this is what I thought. So maybe I can scold them. Okay, maybe I can scold them. Okay, so how much will I scold and to whom will I scold? That is also important. Let's say I want to scold it to a normal traditional method. Maybe I can scold them. Okay, why it's not coming? I'm not able to take the pen. Okay, so for raw material, maybe I'll see first of all what I thought my budgeted cost was. My budgeted cost was 10. My actual cost turned around to be 14. So obviously, ma'am, there is an adverse of 4. Yeah, but now who is liable? If you see the prices, you thought that the price was $5. Okay, I thought that the price was $5, but actually it is 3.5 only. So it's good. If you see the usage over here, if you see the material usage, and if you see the price variance, you will understand, okay, your budgeted price was 5, but actual price was only 3.5. So it's good, na? It's good. It's favorable by how much? Favorable by 1.5. So by 1.5 you have reduced. But how much kgs you utilized it? You utilized it 4 kgs into 4. So it is like 6 benefit. So 6 is the profit. It's a favorable situation. That is 1.5 into 6. 1.5 into 4. 4 kgs. Yeah. 6 is favorable. But what if I say you about the usage? Well, you wanted to use 2 kgs. You used 4 kg. Oh my god. Not good. Not good. Not good. Yeah. My budgeted kgs were how much? If you used to see that. Okay. Just a minute. So my budgeted kgs, what I thought my budgeted kgs were, let's say 2 units, 2 kgs, but actually I took like 4. So maybe ma'am 2 is an adverse into whatever price you thought on day 1. Day 1, what I thought was budgeted was 5. So there is an adverse of 10. So here there is an adverse of 10 and here it is a favorable of 6, which gives me up a negative of 4. So this is what we were doing it up till now. But you know what happened? Can this scenario be happen? Okay, Baba, ma'am, the market only changed. Ma'am, market only changed. Yes, this can happen, guys. The market can also change. How the market can change? So if I just copy this stuff, okay, if I just copy this stuff, you will get to know, okay, ma'am, there can be changes in market also. It's not like market will always be constant. Yeah, market will not always be constant. Over here, if you check on, yeah, over here, if you check on, maybe the market can be different. Maybe the market wanted to be else something, but now it is something. For example, if you see this, guys, this is what I thought on day one. And this is what actually happened. Maybe in between the market has changed. So should I scold them? So you will tell, okay, ma'am, if there is any change in the market, please check what the market has changed. So I'll go and check over here the market. So here I have to check what, guys? I have to check the market. So I will check the market condition and I will make my revised standard. I will check my market condition and prepare my revised standard. What is my revised standard? So when I made the revision in the standard, I got to know that because of the change in the situation in the market, Baba, there is a revised standard. Okay, it's 3.5 here. It's 2 kgs. Okay, it's 3.5, so it was 14. So revised standard, I got to know my raw material, what I required to make 1 unit is not 2 kgs in the market. No, no, no. It is 5 kgs. Oh my God, seriously? Yes, so you require 5 kgs. And if you check in the market, you don't get any price. You get a price of 4. So your eventually cost should be 20. So today, you cannot scold them and compare 10 and 14. No, now you have to compare this 20 and 14. Seriously? Yeah. But ma'am, what about this comparison? What about this comparison, guys? What about this comparison? What about this comparison? Yes, this is also to be compared. So that shows that if there is a difference between the day one's budget and the change in the revised standard, if there is a change, it is known as a change in planning. So it's known as planning variance. So now for me, I have to check these revised standards and consider the actual situation. And if there is a difference between revised standard and actual, is known as operational variance. So what you thought it and actually what you operated it, if there is a difference, it's known as operational variance. So guys, come up over here. What you thought and what you actually were having it, it's normal, which normally people will do, normal variances. But we know that what was the situation and what is the situation in between. There is a market change. For example, you thought like on day one, okay, your sanitizer's price was or mask's price was 20 per unit. But by the end, it was 40 rupees. So you have to see, Are Baba, in the market, you are getting it at the rate of 50. Oh my God, then it is okay. You have purchased at a cheaper price. For example, I'm making it very easy, guys. I'm trying to make it as very easy. Just imagine. On day one, I thought like the mask, for one unit of mask, the mask's cost or price per unit was, the total cost was, let's say, price was 5. So I was able to get it $5 one mask COVID time. But actually, when you saw, actually, you purchased one unit of mask at the rate of $25. So your cost was also $25. So it's better. What I'll do, I'll scold them. Ari, you have purchased very costly. Your price variance of 20. So you will say, please don't scold me. See the market. Go and purchase. The price people will say, why are you scolding me? Go and check in the market. What is the price that you're getting it? Maybe I'll go and check in the market. If I go and check in the market, so I just revised my standard. I went to the market. I got that, okay, Baba, if I purchased one mask, the price which I have to pay is $30. So a total cost is also 30. Oh my God. Then don't you think you have to appreciate them? Yeah, good, huh? You have saved $5. It's a favorable position. But you have to save. But there is a difference in the planning variance. Your plan has been changed. You have an adverse variance of 25. That is 30 minus 5. It's 25. So that is what it is. But is this negative? Yes, ma'am. So you'll say, okay, ma'am, 5 should be and 30 is. So there is a 25 adverse and 25 you actually incurred a cost where 30 was acceptable. So 5 is favorable. So if you take a net 25 adverse, 5 favorable, are you getting 20 adverse? So today if you compare only traditional, means this with this, still you get 20s adverse only. So this is what we have analyzed it. Okay, we'll do one question, and yes, with this we will be covering it up a lot of concepts. Okay, so without having any further delay, let's do one more question. And yes, I'm so pretty sure that your concepts will be very clear. Okay, after doing these questions, like you will be having a super like what you can say, confidence if the question comes. So I have a huge habit of drinking water, like people knows. Like I'll drink a hell lot of water. Yeah. Okay. So yeah. Just give us a minute. I will be doing up the questions. Yeah. Okay. So I thought like yeah, I was wondering whether the question is open or not, but I think like now it is open. So yeah, we will not take more of time, sure. And we can wind it up the question very soon because we have another important topics to be done. Okay, so I'm just making this question easy. Oh, I'm so sorry. Okay, I'll just make it 100. Okay, yeah. See, students, now if you see, I have like solved a lot of question in that, but I have not solved something which is different. Okay, so things which are same, I have already solved it for us, like not to waste more time, but things which are different, I have not solved it so that we can solve it all together. Okay, so over here now, students, if you check the planning and operational variances over here, well, forget about these revised standards. For time being, forget about these revised standards. I'm just gonna hide this stuff. Okay, I'm hiding this stuff. Okay, just if this much question is given to you, yeah, that is, this is my budgeted for 400, for 4500 units. Let's say I require this much kgs of 9000. Okay, I require 9000 kgs at a price of 12.5. So my cost was this. My normal quantity, which I actually required, was 8750, price of 13, and this is my cost. So if it's a traditional costing, traditional cost, my variance is how much? Well, you should take 112,500. You took 113,750 as a cost. Don't you think you had a adverse variance of 1250 adverse? Yeah. So here I have solved it. And additionally, this is what I have my variance. Now, if this is my variance, I have to bifurcate now this variance between material usage for material and for price. So material, you required 9000, but you actually, oh wow, you only used 8750. It's good, it's favorable. So how much units you saved? You saved 250 units around, yeah? 250 kgs, yeah. So 250 kgs is favorable, but at what price, guys? Not 13, obviously 12.5. The 250 into 12.5 is a favorable cost for your material. Whereas if you see for prices, your price should be 12.5, but eventually it is 13 now. Oh my god, it's a loss. It's not favorable. It's unfavorable. Zero point 0.5 is unfavorable. Into how much units? 8750 actually quantity which you utilize. So this is adverse and this is favorable. So if you check this, guys, I have already solved this question. So I don't find like this much is a favorable. And yeah, if I'm just unhiding it, you will get this price of 12.5 and 13.5 as an ADOs. So are you getting this stuff? So if I'm taking up this and this, so 1250 is the total. So I don't feel that there is any doubt still here. There is no doubt still here, right? So this is what is known as a normal thing. This is what is known as a traditional stuff. So I don't find that there is any query in the traditional thing. But now what if I say you, the traditional is gone. Now we have to go ahead and find out what if the things in the market only have been changed. So when you are scolding your price people, that instead of 12.5, you would have like instead of paying actually 13, you would have purchased at 12.5, but you have purchased 0.5 extra. So let me scold my price department. Arey Baba, then they will say, ki, Arey, come here. You are scolding us, na? Come here and check. You yourself check in the market. So this is what was the situation. If I checked in the market, let's say, if I checked in the market, I'm just putting the stuff over here. So you get it clearly. Okay. Let's say if I am just checking the stuff in the market. So maybe the quantity can be changed. Maybe the prices can also be changed. So when I got the information from the market, I was very much astonished because you know what happened eventually? The quantity was increased. The quantity was 10125. Let's say 10125. Oh my god. The quantity what you thought from day one was 9,000. It has increased to 10125. Okay, no worries, no worries. Even the prices have been shown as 11.5. Means what you thought from day one, that is 12.5. The prices has reduced to 11.5. Means whatever the price you're going to scold them or arrange them, it is only 11.5. So in short, your now price should be this. Means now, guys, try to please understand it. Try to please understand it over here. Yeah, now the cost will be this. So over here, this difference of this difference of day one setting budget and revised budget is known as planning variance. You made the revised standard and actually finding it out, the actual difference. This variance is known as operational variance. So planning and operational variance, is it clear? So forget about right now the operational variance. I'm just hiding it. So right now I'm least concerned with whatever the operational variances are. So just hide it up, all the stuff. Okay. So for me, right now, this plan variance is only there. Students, it's nothing different. Just think what we were normally doing it. What we were normally doing it. So we used to see quantities 9,000 actually 1101. Oh, so it's adverse, right? So yeah, so material you used more. You have to use more material. You have to use very much. So how much adverse, guys? What is the adverse situation for materials? So I may be thinking, like, ma'am, where it is a requirement of, let's say, 9,000, you using 1012. So your budget was this much. So, you, Baba, there is an adverse of this much. Okay. At what price? Whatever has been decided at 12.5. Yes, agree. So we get an adverse for material usage for sure. So yeah, I'm getting a material usage adverse. Okay. Then what about price? Price should be 12.5, which you thought on day one, but now the prices have changed. It is reduced. It's good. It's good. It's favorable, right? It's favorable. Favorable by how much? 1. 12.5. No, it's 11.5. So it's obviously a favorable by 1. Yes, it's favorable by 1. How much unit you used? 10125. So that is also a benefit of 10125 if you do it, and you will get the difference. Something favorable, something adverse. So this is your net. So you should get a net. How much? So you thought your cost will be 10125 and actually it is increased. By how much it is bad? It is increased by this amount. 3937.5. Is it exactly the same? Yes. 39375. Students, if you understood this, what you understood was the material. This is known as planning variance. Okay, so we understood about the planning variance for first. Now we are at a position to understand the this variance between what, guys? I'll just try to like erase all the stuff so it is clearly visible for us. Okay. Now when we understand it, guys, we have to find out this standard, that is a revised standard, and the actual stuff. And if there is any difference, it is known as what? Now this stuff is known as our, yes, it's our operational variance. It's known as my operational variance. So how much is the operational variance? Maybe if you want, I can hide now this stuff. It's not important, but still if you want, you can hide it. Okay, so just if you compare it, okay, I don't know how can I hide this, but any which ways, just try to understand it. Okay, on day one, you thought like now this becomes my day one, huh? My revised standard was 116, but only you have an expenditure of 113. It's good, it's good, it's favorable. Favorable by how much? Yes, so you'll say, ma'am, it's favorable. It's you have reduced the cost. Favorable by this amount. Yes, 2687. Correct, correct, correct. 2687, it's correct. But there is also a difference between the material and the prices. Material eventually on the day one was this much, but actually I used less. It's good. It's good. It's good. For material, isn't it favorable? So yeah, I'll say my budget was how much? Budget was 1101, but actually I utilized only this. So it's good now. It's favorable. It's favorable by how much? Guys, it's favorable. It's favorable. Into how much was the price? So you will say, I don't care about whatever is the original price. I'll take this much price only. So this becomes my favorable stuff. So this is my favorable F. Now what about the prices? Array, you thought like, ma'am, your price should be 11.5, but you have incurred a huge price. Oh, so my prices are more. So my budget price was 11.5, but eventually your price turned around to be actual was 13. So that is not good, right? Yeah, so now that is not good. It's adverse. How much kgs you put manufactured it? Ma'am, 8750 you wanted it. If you just multiplied it, this is your adverse. So if you just convert it minus and plus, guys, we need to get this much favorable. So if I did it, I have already taken up the formula. This plus this. Are you getting 2687.5 favorable? And yes. So in the operational variance, if you see, it is favorable. In the planning variance, if you see, it's unfavorable. So if I take up a net, it is this. Yeah, which is 1250. So if you can see 1250, this will be exactly the same as the traditional cost. In the traditional on day one also when we were figuring it out, were we not getting the variance of 1250? So yes, students, this is what we have understood it. I'll just unhide every column and yeah, we will get it. So on day one, this was my variance of 1250. So even if you just calculate, yeah, even if you just calculate this stuff and this, you still get the variance of same. Even if you calculate first this difference and this difference, even if you get the same. Agreed? I hope it's very, very, very clear. See, students, if you don't understand it, I'm so sure that if you do certain questions now, you will get it. You will get it. And I am sure for that. If I am sure for that, so definitely you're going to get it. Yeah? Clear? Okay, so this is what your question is, and I hope you have understood it very, very, very well. So yes, with these, we have completed the planning and the operational variances also, which again is very important. So I'm just not saving it. Yeah, okay. So yes, with this, we have covered a lot of concepts, and I hope you guys have understood it. So with these, beautiful concept of budgeting and control is what I'm going to end it. So yeah, over here. We'll just take a break of 2 minutes and we'll be resuming it back by the important and the most important topic, which is known as transfer pricing and divisional performances. So yeah, let's just resume it after 2 minutes. So students, I welcome you back all, and today we are going to start with the most important topic, which is transfer pricing. So if I just go ahead with the meaning of transfer pricing and divisional transfer pricing, it is something which people have a phobia. Okay, ma'am, this is very difficult. But to be very frank, it is the most easiest topic. And yes, I am so pretty sure that my students love it to the max. Yeah. So the chapter's name, if you know, it is Divisional Performance Evaluation and Transfer Pricing Approaches. So what is the concept behind it, and why is this chapter came into picture? Like if it is APM, then why are we going to learn about this chapter? So maybe a lot of students have a phobia that, ma'am, a lot of questions come from here. Questions means the practical aspects. So yes, students, when it is a practical aspects, it is more easier for you guys to get the marks. So yeah, before I just speak up anything about this chapter, I'll just open it up. The Divisional Performance Evaluation and Transfer Pricing. So if I normally talk about any organization, okay, any organization, there are certain four centers. And I know you guys must be knowing what are the four centers. One of the unit can be a cost center. One of the unit can be a profit center. One of the unit can be like a center could be like a revenue center and the investment centers. So when everybody cannot do the work on its own, we have certain divisions. So if I'm just formulating the meaning of division, division means what? Yeah. So people, you would have understood a chapter number. There was a chapter which is known as business structure. So see, I'm just giving you the highlights of the chapter, which is known as business structure also. So when we are having a business structure, there could be a head over here. There could be a head over here, the board of the directors, under which lot of functions are there. Let's say research and development function, R&D function. Yes, sales and marketing function, production department. Yeah, all these are known as functions, means department. HR department. So these are known as functional or departmental heads. Okay, they are the heads. There are some managers in there. Yeah. And down to that managers, there will be a lot of people who are actually working under them. Yeah, a lot of people, lot of people. Okay. So this is a normal business structure, normal business structure. But for example, if the company is growing more big, if the company is growing more big, for example, if I'll just erase all those stuff, if the company is getting more bigger, bigger in sense how much big? Okay, let's say the company, okay, or I can give you one example of Reliance Industry. Okay, I'll just give you an example. This is what I always give to my students, knows that. Okay, just try to understand it for your business structure. Let's say, yeah, let's say over here in the business structure, when we are talking about divisional business structure, yeah, in the schoolings, when you were in the school, there used to be some division A, division B, division C. So how it was been bifurcated? Let's say if in my standard, in my whatever, first standard, fifth standard, 10th standard, let's say there are only 50 students and there is a capacity of 50 students in a class. So there was no need of division. But let's say if the students are getting increased, let's say there are 100 students. So maybe then the teachers have to bifurcate the students into two division A, division B, that way, right? So same here also. Just imagine about Mukesh Ambani. I know Mukesh Ambani, you must be knowing. Yeah. Mukesh Ambani. Yeah. He is the head of, like, you can see the CEO of Reliance Industries. So basically, he is a CEO. Okay. He is having the huge responsibility. He's also having the responsibility. So wherever there is some responsibility, that factor is known as responsibility accounting and known as responsibility factors. Okay. Okay. Mukesh Ambani is the CEO. Let's say Mukesh Ambani has, under Reliance name, three divisions. For example, over here, it's a petroleum division. Yes. Which division? Petroleum division. Yeah, over here, there are certain divisions. Petroleum division, then telecom division, that is nothing other than Geo, and there is some textile division too. Okay. So these are the three divisions who are the profit centers also, means they are working and earning profits. The company, the division is working and earning profits. So they are going to be having the autonomy, means they are going to decide on what the things to be done and what things not to be done. Under petroleum industry, let's say there are one, two, three, four functional heads. Let's say production, sales, HR, research and development, HR. So here also 1, 2, 3, 4 functions: production, sales, research, HR. Here also different departments. Under that, people will be working. So over here, if you see, these guys are the production department is the concerned with the cost reduction. Sales department is concerned with the revenue increase. Okay. And these petroleum division is concerned that they should have the profits. And Mukesh Ambani will be interested to know where to make investments. Yeah. Over here now, if you can analyze it, I'll make it more beautiful. Yeah, just try to understand. Over here, Mukesh Ambani will not be concerned. Acha, in textile industry, what is the cost percentage? No, no, no. He'll be interested to know only if he's having extra funds, where to invest, in which division to invest. Let's say the textile division is running into losses. Petroleum is into profit, and telecom industry is the best profitable. So if Reliance Industry wanted to invest more money, definitely he'll be more of interested into telecom industry and would try to cancel this textile, use these funds and to transfer it in these two divisions. So who will take up all the important decisions? It will be known as the CEO, or I can say the investment center. Yes, the investment head will be trying to do so. So over here, when I'm talking to you about the division, so you will say, ma'am, why are we understanding this in this chapter? Because we are going to learn about the divisional performances. So what's the meaning of division? Okay. So how are the divisions coming up? What are the preferences of the division and all? And then we'll be understanding the transfer pricing. So yeah, with this overview, we are good to start with the divisional performance measures, and I'll try to explain you in the most easiest manner. So from the exam perspective, guys, you have to understand this topic, which is return on investments, that is ROI, residual income, and EVA-TM. Yeah, this becomes important. Okay. Now, I'll just explain you. See, as I told you, when it is a divisional structure where there are four centers. First is cost center, then is revenue center, then it is profit center, and the last is investment centers. So when it is a divisional head like Mukesh Ambani, he will be more of interested into knowing the investments. Individual division will be like a profit center. If it's a production head, he'll be concerning about let the cost be reduced. If it's research and marketing, so they'll be expecting let my cost be reduced. If it is sales department, they'll be expecting let my revenue be more. So they are doing what? They are doing their own autonomy of businesses because they want their profits along with the company's profit too. Okay. So there is a feature in the business practices which have split the organization into semi-autonomous, means the company can have its earnings. The company can take up the individual and the independent decisions too. Okay, and these are nothing other than known as divisions. These are nothing other than known as divisions or maybe subsidiaries or known as SBUs, strategic business units, SBUs. Okay, clear. And these can be, I told you there are four centers that is known as cost centers who will be taking care of managers responsible for cost. For example, production department, research and development department. Revenue centers will be more of concerned about revenue, like sales department, yeah, marketing department. Okay. Profit center will be considering what? If I want to earn profit, like the textile department want what? So they want the cost to be minimum and they want their revenue to be maximum so that they can earn a profit. Yeah. So managers will be responsible about cost and revenue. And last, when it is an investment decision means, like I told you, Mukesh Ambani sitting at the price, he'll be having extra opportunities. So he'll be wondering where to make the investments, where it is a better place to make an investment. Yes, I hope we are going it very beautifully. Yes, I'm not hustling, I'm not running for sure. Okay. A full-fledged SBU, strategic business unit, may be like a investment center. As I told you, Mukesh Ambani, Reliance Industry. Reliance Industry is like an SBUs. It's like an investment center who takes up the responsibility where to invest. Yes. Before I go ahead, I need to explain you one word which is known as goal, congruence. Guys, this word is going to be there hundreds of times, if you see divisional transfer pricing, if you see the divisional performances, where you are supposed to write it. So it is goal congruence. Okay. For example, this is division A and this is division B. Let's say division A wants its own profits. Let's say division B also wants its own profit, but they are earning profits in the namesake, and they are just earning for their sims, just for their own benefits, and not taking into care about the company's position. Then it is a loss. Then it is a loss. Then it is a loss for whom? That means then they are not concentrating on from the company's perspective. So they are not doing the goal congruence. That shows that before looking into how to measure this, we need to understand to ensure that the managers take decision in the best interest of the organization as a whole and not for individual division. They want the company to grow, not the individual division. Yes. Then obviously the company would want to have a proper coordination and a controllability. Means if there is any problem, let's say about the production, I should scold the production department, not the sales department and not somebody else also. That way. If I then see, yeah, about the performances, interdependence of division is also important. Like you'll say, ma'am, why interdependence? Okay, I'll give you one superb example. There is division A and division B. Okay, I can make like this. Let's say, guys, there is division A who manufactures what? Who manufactures, let's say, bottle. Okay, bottle. They manufacture, let's say, plastic bottle. Manufacture, okay? They manufacture plastic bottles. There is division B who prepares Coca-Cola or whatever juice. And then they pack it and make a bottle, like a juice bottle. That means what, guys? Over here, they make some drinks. So B division makes some drinks and they require the bottle to fill the drink, right? So maybe division A manufactures only like this bottles and division A prepares this inside thing. Okay. So now division B wants to sell. So they require division A's product also, division B's product also, right? What if I tell you the division B, sell the bottle. Yeah, I sell the bottle, sell the juice, complete juice or soft drink in the market at the rate of $20. Okay, I sell it at the rate of $20. Division A manufactures plastic bottle at the rate of $7. Division B, okay, this is bottles cost. The cost of making juice, only that Coca-Cola's juice, by division B, it's let's say $6. So what can be the total cost of manufacturing? So you will say, okay, ma'am, 7. So for B, he will purchase a juice or he'll purchase a bottle at the rate of let's say $7, and he'll have its own juice manufactured at the rate of $6. So maybe his cost will be $13, and if he sells at $20, he'll get a profit of $7, which is which we expect. This is what it was fine way back it was fine. But today all the divisions are also profit center division. Means division A might not want to sell at $7. They want to add their own profit margin of let's say $3, and they want to selling price of $10. They want to sell at $10. Oh, so maybe if now if B purchases, he has to not purchase $1, he has to purchase $10. So now maybe his cost will be $17. Yes, maybe now his cost will be $17. It can happen, yeah, it can happen this way also. So yeah, it can be, ma'am, now $17. Yeah, this can also happen. If you see, if B also wants a margin of let's say $5. If he wanted $5, so if he add $5, it will be $22. Don't you think his cost will be like $22? And if he sells in the market, the normal selling price is let's say $20. Nobody will purchase that product at $22, right? This is the goal congruence. Means what they are doing, just thinking from the division's perspective. Division wants profit. This division wants profit. Arey, but what about company? Nobody will purchase. So you are getting profits from your stake and not from the company's perspective. And this is what is known as the goal congruence. Okay. That is known as interdependence, like how to measure the performances from A's division to B division, interdependence. There could be some cost, like head office cost, which is normally incurred. Now that I have to divide it, allocate between both this. At what I'll allocate it or what I'll apportion it. Maybe there is some activity ratio on that we can do, and you have to understand about transfer pricings also. Okay, till here I hope like everyone is fine, like we are getting it. Yeah, we'll be doing a lot of things, so please don't worry, we have a lot of things to understand it. Okay, now the measure used will depend on type of business units to be monitored. Like how will I monitor the business? How will I go ahead with the business? It is dangerous to focus on only one key factor. Like I have to focus on both the things. Both means the financial perspective plus the non-financial factors. I have to concentrate on both means financial and non-financial, which is a balanced scorecard approach. You remember I have explained you what is balance scorecard. So when it is balanced means it's a financial factor and non-financial indicators. Financial means financial. Financial means financial factors. Yeah, I remember. Financial means financial factors. But when it was non-financial factors, they used to concentrate on customers' choice. Yes, they used to concentrate on learning and growth also. And they used to also concentrate on some technology also and innovation. Yes? Okay. So that was the stuff. Now, this is what we have just analyzed about the theory. Now, the important topic comes like we need to understand about some measures. Like how will I measure the differences, which is known as some ratio analysis. It was very simple, like GP ratio, NP ratio, EPS. Then we have some ratios which is known as ROI, return on investments, ROCE, return on capital employed, and so on. Then we have return on investments to understand. Yes, okay. Then we have, guys, residual income, RI, and some non-financial factors. We have EVA also to learn. So all these stuffs we are going to understand it. So guys, this is something which I hope you guys have already have a knowledge of, which we have understood in the chapter ratio analysis. So what is the meaning of net profit margin? What is the full form? Like what is the formula for net profit margin? Yeah. So when I talk to you about net profit margin, it is calculated. It's a ratio considering the profits. It's a ratio considering the profits, which says what is your profit? What is your net profit divided by what is your total sales? Yes, guys. What's your net profit divided by your total sales? Is that scenario. So we have profitability in that net profit. So net profit upon sales, gross profit upon sales is the GP ratio. What is contribution? Revenue or whatever the sales minus variable cost. We get a contribution. Then we reduce the fixed cost. Then we get some profit. Okay, so this contribution upon sales and some expenses. So if I'm doing all this stuff, I get what? I get the profitability ratio. I get the profitability ratio. Then guys, we have a concept which is known as, okay, we have a concept which is known as liquidity measures. So it's liquidity. I need to know whether am I having sufficient current assets to satisfy, to pay off my current liability. Means am I having sufficient enough cash or sufficient enough current assets to settle my current liabilities? If yes, it's okay. But if you don't have, we'll be saying now we are having a liquidity crunches. Means we don't have enough of current assets to fulfill our liabilities. Yeah, so this can also be a situation. Then we have some current ratios, quick ratios. Yeah. So if I just ask you, what is the formula of current ratio? Yeah. Can you tell me what is the formula of current ratio? Yes, students, we need to know. This is also the topics which we have understood it. Yeah. So if you want, I can just make it like that. Insert one new slide for you about this. Yeah. If it's current ratio, if I'm saying about the current ratio, it is something around current assets divided by current liabilities, which should ideally be 2:1. So your assets should obviously be more than compared to your current liabilities. Then we have another which is known as quick ratio. So what's quick ratio? Current assets minus inventories upon current liabilities. So this is known as quick ratio. How quick my assets are going to converted into and being able to make a payments. Now what is receivable days? Within how many days Within how many days your debtors make you a payment. Okay, if it is less, it's good. Like within how many days you are at a sufficient position to get money from your debtors. Okay, debtors collection. Yeah, so basically it is understood as the receivable account debit to sales, no, to average, or we can say net credit sales from whom I am supposed to get money. If it is days, multiplied by 365, multiplied by 365. Similarly, for payable, it goes payable account debit to net purchases, that is credit purchase, into 365. Then we have inventory turnover ratio also. Some other measures can be like salary per employee or sales per employee, key factors, transportation cost, and overheads per cost, etc. etc. So these are certain normal ratios. These are certain normal ratios which the company has, which it normally produces it. And today, when we use a lot of beautiful technologies, which is known as ERP software and all, so we don't use to apply our brains. We directly have it as a formula. Means if I click on some F12, I can directly get all the ratios. So that is something which is fine. So if I get the ratios, is it enough? So you say, okay, ma'am, ratio will be in the numerical terms or maybe like in the percentage form. That will not be enough until unless you have to also add the non-financial factors. For example, if there is a lot of, let's say, uh, staff turnover, so a lot of people are leaving. I have to write why are they leaving? Why are they not present? What is the reason? Are they not happy? Is it something which we can satisfy them? So even that needs to be analyzed. Then have I gained a new customers, or my customers are getting retained, or my customers are not satisfied, or the customer satisfaction with the scores like 1, 2, 3 ratings I can give, and I can go ahead. Then proportion of repeat booking, how many people are like retained, how many are liking it, and what's the customer received order. Maybe what is my setup times, new product developed, percentage of returns, rework, and all such stuffs. Okay, so all these things can be taken care of. Now we have understood a lot of concepts which are like, okay, now we are at a position to understand the important topic. Now see, I'm not going ahead with all this stuff right now. I am not reading it over here. I just want to make one thing for us. Just give me a minute. Yeah, if you just try to correlate it, it will be very helpful for you all. If you try to understand this divisional wise sales, okay. See, we'll be going it very slow. Huh? We'll be going it very slow because once you understand it, it is superb. So there is one division who sells the goods to other division. If I am the bottle making division, I want to sell my bottles to the manufacturing of the goods. So I'll be known as a transferor division, and that will be known as the transferee division to whom I am selling it. I am the transferor and that other division is the transferee division. So let's say division A manufactures, let's say, bottles. Division B, let's say, manufactures what? Let's say the juices and sells it. Okay. And yeah, this is my company situation. This is my company. Okay. Over here, I am known as what? I am known as transferor. It's known as transferee. And this is my normal companies. Okay, company. Clear? Yes. Now, tell me this scenario. Okay, please. Over here, it's a sales. So, for example, if I am going to make a sale to whom? Let's say I don't make to company. Like my company has to make a sales, but I don't sell it to, let's say, chalo, let me sell outside also. Let me sell intra also. Means. You know what happened? Yeah, this can also happen, huh? Just try to know. Uh, if you guys agree it, I'll be very happy to know that. If you, okay, just give me a minute. Yeah. Yeah, it was just like flipped about. So yeah, it's a transferer and it's a transferee. Okay, students, try to understand. I am division A. I sells the bottle to division B also, and still I can sell the outside parties also. So outside people also, if they want, I can sell it. So let's say my normal selling, my outside sales is, let's say, normal sales is, I normally sell at selling price, my normal selling price to outsiders for division A it's let's say $10, but I sell it to my insider. To my insider means my transfer. If I'm transferring it to transfer to my B division, I sell it at 8. Okay, cool. My let's say my B division, also sells the product at what price? Let's say my division B sells the product at 20. Okay, they sell it to 20. Okay, maybe they sell it to 20 or 10. Okay, just per thing I'm writing it. They don't have anything internal. So if you see the company's total sales is how much? So if I say this 10 plus 20, 30 and 8 will not be right. Okay, I'll explain you how and why. Okay, I'll explain you how and why. But right now, if you see, this is a selling price. Minus you will do the variable cost. Let's say for unit A, the variable cost is let's say $4. Okay, cool, cool, $4. For unit B, let's say the cost is $5. And you also know that this is their own cost. Means to make the bottle, I require $4. To make the juice, I require $5. But if you remember, B also requires this internal, also means B also requires the bottle. So the bottle is now available at $8. Agreed? Yes. So if you see this, yeah, please try to analyze this. Please try to analyze it. What I'm trying to speak is this. Yeah. Yeah, what I'm trying to say is this, guys. Yeah, over here now, this $8. They want $8, they want, okay. B wants $8 also, like because they have to pay for the bottle. So if it is a situation, can you tell me what will be the total cost? If I see the total cost is let's say 4, and over here 8 plus 8 is 13. So if I just get it, what will be my profit, guys? What is my profit? What is my profit left over with? Okay, if I see my profit over here, I can get it something like 10 plus 8 minus 4 if I'm doing it. If I want, I can get it like that way. But you know what? We can understand in this fashion also. I'll just show you. 10 plus 8 minus 4. Am I getting around 14? Yeah. 14 is a profit. 20 minus 5 minus 8 is equal to 7. So if you see, this company is having a profit of 14. This company is having a profit of 7. Is it so? So we have to go ahead with the company situation. So it's 10 plus 20, it's 30. Can I take 8? No, for the company, internal things, you can cancel it. So it's nothing. So their cost will be how much? Their cost will be 4 and it's 9. So is it 21? Are you getting 21? 14 plus 7, is it 21? Yes, guys. So this is how we normally calculate the stuff. This is how we normally calculate the stuff. So I'm just trying to tell you that when it is internal transfer, it is not a sale for company as an outside party. Agreed? Yes. So this is known as the profits, which is known as the controllable profits. What we get it means there will be there will be a transferee. Transferor would sell it to the transferee for sure, and the transferee over here, yeah, the transferor would sell to transferee, and the transferee would utilize it and add the cost and then make a sales to outside party. And this is what is a situation which normally happens. Okay, this is what the normally happens. So now when you read this, maybe you can find it a bit easy. That is, the principle of controllability means when assessing the performance of the manager of the division, only those items will be controllable by manager which are used for calculating profits. That is the controllable profits. It does not include anything which is under not a control, like the head office fees and all, which is not under the control. So we will not take that. But while assessing the performance of division, so if you see these two words, by performing of the controlling of the division, we get the controllable profits. But when I assess the performance of one division, not the manager. If I want to analyze for manager, it is controllable. But when it is division, I have to find out what? I have to find out the traceable profit. Okay. Yes. There are certain calculations. If you can see this. Yeah. This is what we did. The external sales. This is for the company. The external sales, the internal sales, the cost. Now what I get it over here, the profit is something which is controllable by management. Then we have some fixed cost, like the head office cost or something, like whatever the fixed cost are. If I reduce that, I get the controllable profit, which is the profit of division, and this is a profit which is earned by management. Okay, so we have what? We have traceable profit, and then we'll allocate any sort of head office cost, and we get the divisional net profit. Okay, this is just for one, so we'll just read it. So controllable profit means the manager's performances, and traceable means to trace it in the division. Trace it in the division. Okay. Then, if you read it, yeah, we have already covered this cost center and all, so we'll just not waste more time. So cost center means we have to incur the cost and not the revenue. Okay. Okay. Then if it is a profit center means you have to concentrate both on cost and revenue. Okay. Fine. And when it is investment center, you will concentrate on both, but you will be having more to do the investments. For that, we have to learn these three parts. For that only, guys, we'll be learning ROI, return on investment, residual income, and EVA, economic value added. Okay. Now, with this, we have completed the initial portion of what are the stuffs which is known as the like we entry level things are done. Now we'll be starting it with the most important topic which is known as ROI, return on investments. So what are these? These are known as the divisional performances measures. How I want to measure the company, how will I go ahead, etc. etc. So see students, like just take a 1 minute break or breather for yourself, drink water and start again because this becomes important. This becomes important, okay? Okay, I'll just take a break of 1 minute and yeah, we'll be starting with ROI. So students, let us start with the most important topics, which is known as return on investments. In the normal language, we consider it as an ROI, return on investments, right? That we all know. So what is the basic meaning of ROI? Okay. If I just say it is something like, okay, you are having some investments, or maybe you would have invested in some of the other assets or maybe things. So compared to that, what is the amount you are getting it, right? What is the income that you are fetching it out of that? Okay, so that is known as, just give me a minute, it is known as return on investments. So before I go ahead with the concepts of ROI, I'll just try to explain you with the example. Okay, then we will read it. Okay, let's say for example, there is company A or maybe division A. Let's say it's division A. Okay, the division A has to understand whether the investments which has been given by the company. So let's say there are two divisions, right? In the return on investments, we have a concept compared to, and in the concept of divisional performances is such that there will be some investments which the company is planning to do. Okay, let's say there are two divisions and the company is planning to expand more. So the company thought ki where to invest more, right? In which division should we invest more? So how can that return on investment help us to find out in which division should we invest more? For that, we have a definition which is known as ROI. That is, return on investment expresses the divisional's profit as a percentage of assets which are being applied in the division. So you'll be thinking, ma'am, we are not getting it. For example, investment is what asset for me. Like investment is my asset. So I have to analyze ki by applying this much of assets to my company, what is the income that I'm getting it? Okay, let's say for example, in division A, let's say there is an option that if I'm proposing up a division, if I'm proposing an investment, if a new investment is added of let's say 20 lakhs, okay, I get a profit of how much? Because of that, I get a profit of let's say 2 lakhs. That shows what is a percentage of investments. What do you think? What is a percentage of investments? So you will do, ma'am, profit divided by investment. So you get some 10%. Exactly. So that shows okay, if I invest in division A, I get a return of investment, that is profit upon investment into 100, which is equal to let's say 10%. Currently, my company is into working only. Means right now also my division is earning something. So right now, if I analyzed my normal profits, this is was proposed, maybe. Right now, if I analyzed, I am having a present ROI of let's say 13%. Let's say my current return on investment, which I can normally find it out, is 13%. So what do you think? Will this division A accept a new investment who generates only 10% of profits? I don't think so. Instead of that, just imagine, instead of that, let's say there is division B. Okay, instead of that, let's say there is division B. For them also, let's say the proposed thing is 20 lakhs. Okay, and they can earn a profit of let's say 1 lakh 40. For them, let's say it's 1 lakh 40. So what do you think by proposing this division? What can be their return of income? So if you can see, it's 7%. It's 7%. And if I see for division B, their normal current earnings are 5% normal earnings. So what do you think? Which division will be happy to accept a new project? Guys, this is my new project, okay? This is my new project. And my new project is generating 10% and 7%. And this is what my existing product of 13 and 5. So if I just see this, I feel like, okay, division A is any which ways earning 13%. So if I invest the funds and I get only 10%, that's not so better. Division A will be interested if division A gets something better than their current return, right? But what if I say you division B will be feeling, Arey Baba, my current return is 5, I'm getting it 7%, let me invest. This is what you are thinking it only from the division's perspective. But what if I say you, the company's cost of capital or cost of ROI, the company's ROI is let's say 8%. Means the company wants minimum 8%. The company wants minimum 8%. So if division B invests, the company will get only 7%, which is not acceptable. So if the company wants division 8%, the instead of or despite of A don't want to enter into the division, they don't want to enter into this perspective of investments, still they have to do it because this is what the minimum company wants. So when it is return on investments, our students, I'll just express it slowly. Return on investments. Now, if you read the theory, you'll understand it more. Return on investment means it's a profit which is available towards so much of investments. Means by blocking so much of funds, if I get this much only return, I'll find out my percentage. I'll get my normal percentage. I'll get my current performances. So currently also I'm getting this much percentage and I'll check it out. What is the percentage I'll get it if I invest this much more? Yeah. So that is what it is, normal situation. But when I say about the divisions, both the things can be as such. Means considering only the division's thought will not be fine. Considering only the division's thought will not be fine. I have to also concentrate on what the company minimum wants. Company wants minimum 8%. So I have to anyhow satisfy the company's choice and go ahead. So this is what the return on investments is. So before I go ahead and I'll just try to like explain you, I'll just write something for us. So that will make our concepts more easy. Okay. The return on investments means what? It's a profit. It's a profit that you have to find out. But what is this profit? It's known as controllable profit. It's known as controllable profit. We have to find it out, which is basically if you check profit before interest and tax. So we have to do it if anything is given up. Yeah. Then if head office is not given, ignore. If it is given, please add it back. Okay. Then we have investments. So what is investments? Investment is nothing other than the net assets, which means current assets plus non-current assets minus some outside liabilities, means that is nothing other than their equity portion also. So yeah, that could be a stuff. So don't worry, don't worry. We'll just read the theory and then we will understand it. What is return on investments? The profit or the gain which the activity or the company gets it by doing what? By doing an investments. So ROI is divisional equivalent of ROCE. That is return on capital employed, used to perform what the division is going to have it and what the manager is going to have it. For that we have profits. But profits of what, guys? It's PBIT because interest is affected. So by the decisions. So we normally take it as profits before interest and tax. So we don't deduct in interest, we will never deduct because when we see the liabilities and outside liabilities, we want something for the equity holders also and the, let's say, debt holders also. So we want interest there. So we will take that profit, that is operating profit, that is profit before interest and taxes. Yeah, so we'll take that profit before interest and taxes because interest is affected by the decisions. So if I take PBT, yeah, that is my controllable profit. So I have controllable profit divided by capital employed or like investments. What is the amount of I have employed it? That is controllable profit. And for division, we take traceable profit. In that, we will incur the head office cost also. So, decision how will I take? If the return on investments, if my ROI in any division, division A or division B, let's say if it is more than the cost of capital of the company, then please accept the project, otherwise reject the project. So now if you read the question, now if you understand it, this is what the proposal they have set it. This is what the company's present ROI is. Means presently they are earning 13% and 5% each. If the company decides to make investments in division A, their investment purposes, let's say 20 lakhs, they'll get a profit of 2. Means the current return is 10% if they accept the new project, and if B accepts the new project, for them it is 7%. Looking at it in the individual divisions, I feel like division B, who is having 5% and now will be 7, he'll accept it, and not division A, because from 13 he has to reduce to 10. But this is important. Company wants minimum of 8%. Company wants minimum return of 8%. So minimum of 8%, so you have to accept it anyhow. If you have to accept it anyhow, so this 7 will not be acceptable. You have to accept it 10 and go ahead. This is what is a return on investments. So I hope you guys understood it very well. Yes. Now, there are certain advantages and there are certain disadvantages also. So its ROI means it's easy to compare it because there are two divisions, easy to compare it. So if something is comparable, it's my relative. So we have relative measure. I considered what big my entity is, what big my investments is, right? It's similar to return on capital employed only. Yeah, ROI. Then it focuses on the capital resources, and over here it reduces some non-essential things. For example, unused fixed assets and all, you will just reduce it. It can be broken down into many other ratios also. Easy, easy. But the disadvantages is the capital employed is subjective. Like non-current assets, should I book or not? So what will happen, people will manipulate the investments balance. Why will they manipulate the investment balance? Because in this what we have, profit before interest and taxes. So over here, if you see, depreciation is also deducted. Yeah, agree. If I want more profit, I will have a less depreciation. So people will do what, if I'm having in my financial position this asset which is very bad, the value is very bad, means like it's of no use, I should have thrown it out, but still I will show it because my depreciation will be less. But what if I just disposed it off and I purchased a new asset with a heavy value? So more the depreciation, less the profit is. So people don't want all those stuff. So they will continue using whatever their assets are. So students, this is the way they can change it. For example, the non-current asset may be valued at carrying amount or historical amount. Instead, there is a possibility that if they if the asset is of no use, please don't record it. But still they will record it. They will not purchase new asset. Because if they purchase new asset or they lease new asset, the expenditure will be more. If it's a new asset, the debris will also be more. So they don't want to show like that. So these are the disadvantages which people have come across and they will do, and that is for sure they will do. So to avoid that, we have some what you can say, some window dressing they do it. Like for example, they will do under investing, or maybe they'll be having some cost cuttings and all. Yeah. So that is what is my ROI, a return on investments. And to overcome this ROI, we had a new concept, and not a new concept of RI, that is known as return on basically residual income. So if I see the residual income, I thought like maybe residual income can help me to overcome the ROI's weaknesses. But to be very frank, RI had its own weaknesses because of which RI also didn't work well. Seriously, RI also didn't work well. But what is the meaning of residual income? So in this residual income, this has come across to promote the goal congruence. Means, again, if you take that example, you will be having some proposed investment. Now you don't see what is my earnings. I will not see what is the percentage of profit I'm getting it or not. No, that is altogether different. That is altogether different. First see, are you getting that much profit which the company wants? For example, in my residual income approach, let's say there are two division A and division B. Same question. Let's say my proposed investment was 20 lakhs only. Let's say 20 lakhs. Or here also it was 20 lakhs. Okay. You remember what profit they were getting it? Yeah, they were getting a profit of, let's say over here, they were getting 2 lakhs. And over here, if you remember, they were getting 1 lakh 40, right? But now they have clearly given that, Baba, the company wants minimum 8% cost of capital. That means, what do you think? What the company wants minimum, how much profit wants? Minimum profit of how much? Minimum profit of 20 lakhs into 8%. That is 1 lakh 60. From A also, from B also. So what do you think? Which company will accept the project? If you see, division A is having a profit of 2 lakhs. So maybe if I see the difference, if I see the residual income, the residual difference, yes. So you will say, ma'am, they get a profit of 2 lakhs and 160 for them. Okay, cool. So it is 40 positive and it is 20 negative. So something which is positive, you should go ahead, and something which is negative, you should ignore it. So what they did it, they just have the investments. They will multiply with the percentage of cost of capital which the company wants. They will see how much you guys are earning it. If you're earning it better, it's okay. But you know what, in this, it's a very negative factor, because I don't compare anything which I'll never compare anything with the investment what I had, which my normal, what was my normal situation. I didn't have anything like normal. I'm getting 13%, now it's 8%, not like that. So maybe I'll be ignoring some factors. So that is the reason My residual income is also known as an absolute measure and not the relative measure. So my RI is also known as absolute measure. So maybe you'll read it, you will get to know. So what I get it, pre-tax profit less interest computed, that is what imputed. So interest I'll not consider it. That is residual. So if you read this now, interest for cost of capital, before that you just read it. What it is, pre-tax profit less means this is my profit, this is my profit, this is my profit, 2 lakhs and 140, which is this profit before interest and tax. Minus this 160 is was cost of capital into amount invested, right? What the company wanted. Yeah, get the difference. Yeah, see now read this. The profit, pre-tax profit, less what the company wants. Yeah, what we will do by creating a by deducting the interest expense of the company from the cost of capital from my profit. So I'll get the same. So this is what it is. My profit, controllable profit was 2 lakhs. Yeah, the company wanted the interest of 1 lakh 60. So I'm having a profit of 4 lakhs, sorry, 40,000. So yes, I should go ahead in the question. Yeah, I should go ahead in the question and not in this. So yeah, this is what is for the managers, it's controllable. And for the division, it's traceable. Traceable means in this head office also we have to understand it and get the total. So this is what it is. So if you read now, what is interest? They have wrote the interest. It's nothing other than you remember in like they had a capital of 20 lakhs. Yeah, investments. On that the company wanted minimum 8%. They just multiplied it, got 1 lakh 60. It's nothing other than this. So interest is equal to how much, guys? Interest is capital employed, how much capital I have employed it, multiplied by what is my rate of 8%, and I get this known as interest. Clear? What is the decision? I will see. If I'm getting anything positive, like 40,000 was positive, if it's positive, accept. If it's negative, reject. Yes? Easy? Yes. In these, what are the advantages? First of all, over here, it reduces the problem which was there for ROI. To overcome ROI, we have RI. Because in these, I am not at all concerned with my company's original percentage. You remember what was my original percentage? 3% or 5%. So maybe I will not manipulate any of the fixed assets and all because I don't have concern. I'll just consider it whatever I'm getting a profit for. That's all. That's all. Right? Yes. Then a risk adjusted for COC is also not there. But obviously, there is some disadvantages again for that depreciation. Window dressing of the capitalization. Yeah. As per ROI which we had. Difficulty to compare of the different size because I have, let's say, only profits. Only profits. You remember why disadvantages? So again, I'll ask you. It's division X, for example, division X and division Y. Okay. If I said you, okay, my company is having an investments of, let's say, 1 lakh. And here, my company is having an investment of, let's say, 20 lakhs. Oh my God. If I see the profits for the company is, let's say, 20,000. Here, my company is having a profit of, let's say, 40,000 or 44 lakhs. If I just see 20 and 4, I always understand, okay, my 4 lakh is better. Like, yeah, maybe, okay, I'll just ignore it. Like, I'll consider, okay, I'll just change one figure. Instead of 20, just consider it. Instead of 20, just consider it 50 lakhs. So what I used to do in the question is, over here, if you remember, we were taking only the profits. My profit was 2 lakhs. My profit was 140. So I thought, ma'am, this is better. Did I consider my ROI? Did I consider my return on investments? No, nothing like that I considered, right? I considered it nothing. Like legitimately, I considered nothing. Why? If I would have considered the percentage, which in ROI we normally calculate, if it is RI, if it is return on investments, I will feel better the profit is of Y. Because Y is getting 4 lakhs profit, ma'am, superb. But I'll tell you, are you mad? Please check what is the percentage of return. By investing 1 lakh, the company is getting, X company is getting 20,000. Okay, 20,000. So 20,000 divided by 1 lakh, if you do it, is we get a 20% profit. Oh, so division X is giving you 20% profit and division Y is giving me 40,000, 4 lakhs divided it by 50 lakhs, which gives me only 8% profit. So over here, it's giving only 8% profit. But still I will accept. Why? Because it is not considering different sizes. Why? Why? Because it is an absolute measure. Means you have to only take the profit figures. In that question, what we used to do, we were calculating the percentage. But in this, no percentages are calculated. So you only take the figures and go ahead and do the wrong thing. And now the company will invest in division Y instead of using it in division X. Because they feel, oh, division wise profits are more. Ari Baba, please see what amount of investment they made and they got the profit. They got very less profit by making so huge investments. Yeah, that is also a hindrance. Okay, clear. That was also not acceptable. Now that RI, ROI, and RI, both of them are not acceptable. Up next, what to be done? Okay, up next. Oh, what then? What could be done next? Then we have a concept of EVA and ROI. Okay, I'll just read it for like ROI and depreciation, which is very easy. We have already learned it. So what is the effect of depreciation? For example, if you purchase a new asset, and if I'm having a old assets carrying amount, let's say the carrying amount of my asset, which is old, it's let's say 2 lakhs, and you expect it still 10 years are there for your life, 10 years life is pending. So you will depreciate 20k and book it in your P&L statement, yeah, and you'll be having a carrying amount of 180. But you got to know, okay, whatever the asset is carrying amount, it is waste. Nobody can use it. It's very bad. Instead of that, it's a situation that you have to purchase new asset. If you purchase new asset, maybe your cost of purchase is let's say 40 lakhs. Oh my god. And the life of the asset is let's say 10 years. It's okay. Your life is 10 years. So maybe 4 lakh you will depreciate it. So your balance will be 36 lakhs. Oh my god. Or whatever whatsoever the stuff is. So what I can compare it, if I would have purchased a new asset, my depreciation will be more, means my P&L losses will be more compared to what it was, right? Along with that, if it is a situation, my ROI and RI will rise to 10 and maybe decrease or whatever the stuff is. So if the capital employed is defined as per book value, then whatever we do, SLM basis, we start putting the depreciation. Yeah, that is what we normally do. Then the over the life of the investments, we have to see whether my capital employed is getting fall. Yes, why it will fall? Because your asset is going to reduce all the time. Asset is going to reduce all the time. Asset reduces all the time. From 180, it will be reducing more and more and more. And ROI and all will increase. Why? Because your profit will be less, divided it by the number of investment also. That could be a reason. Hence, if you see this, the SLM depreciation inflates even if the actual performance is constant. Why depreciation will inflate? Maybe if you think like you're changing it, original what it was and now it is, you have to change it. So it will increase. So your stuff is wrong. Okay, that could be a situation. There could be also a conflict with your NPV also, net present value also, because projects with positive NPV, positive net present value, increases the shareholders' wealth. Okay, Baba, I'll accept it. But if it is ROI and RI, it will be like based on the performance appraisal and all. Maybe that can be a negative factor also. This is because of SLM depreciation, yeah, which has to be reported in the next years. Okay, yeah, cool. Okay, with this we have completed some small topics. Now coming up to the most important topic, which is known as EVA. So what is known as EVA? Economic value added. So basically this EVA, economic value added, is a measure which actually analyzes the profit, which wants to show, okay, what is the real value creation or the worth of the company. Means if I think the EVA is positive, it's good. That shows that the company's performance is acceptable, the company's performance is good. But if I feel the EVA is negative, it's very bad, that means maybe the company is not performing very well, isn't it? For example, if I say the EVA is equal to, you get somewhere, if you just saw ROI, RI, for any other ratios, I don't find most or the less any value for my equity shareholders and my debt holders. I don't find it. But over here, I want something as a profit which is left over for whom? a profit which is left over for the equity shareholders and the debt holders. So for that perspective, we have EVA, which is known as economic value added. So we have EVA, which is also understood as NOPAT minus COC. What's that? NOPAT, net operating profit after tax minus cost of capital of the company. NOPAT is net operating profit after tax minus WACC into CE. Means weighted average cost of capital multiplied by what amount of capital you have employed. If the EVA is still positive, you go ahead, otherwise not. So if I just explain you short way, okay, yeah, it's something net operating profit after tax. So how will I calculate net operating profit after tax? Now for that, we have one format. Which says, okay, which says that line, I'll just write it. To calculate NOPAT. First of all, you have to understand what is NOPAT. How will I calculate net operating profit after tax? So operating profit you want, but after taxes. So taxes also to be deducted. So we always get like operating profit before interest and tax. So ma'am, why I took this word interest here? Because in EVA, guys, I want some profit available to debt holder also, to equity holder also. So to debt holder, we give them interest. To equity holder, we give them maybe in the form of dividends. Yeah. So we need to find out operating profit before interest and tax. Out of which what I will do, I will normally calculate what I will normally minus interest out of it. So then ma'am, you will say, okay, we will get what? We will get like profit before tax. I will reduce tax from here. So I'll get profit after tax. Then ma'am, it's what? Ma'am, I got this part. But I want no but net operating. But this I want for my equity holders and my debenture holders. Then what to do? Then again add interest. But net of tax. Net of tax. Then we get no PAT. Net operating profit after tax without any adjustment. Till now, without any adjustments. So why I do like that? Because I want first of all you reduce it so that you get the proper tax amount. And then you get it, okay, add again interest. So that much is what available towards your like towards your parties, okay, towards your people. So students over here now, I'm not going into any solutions for you because otherwise it will take a huge amount of time. Okay, it will take huge amount of time and it is a revisionary part. So definitely I am expecting guys you know these concepts. Okay. So this is what is a stuff. Okay, this is what is a stuff. And maybe if you want, we can solve one question also, which is there. Just maybe let's say we can do it or not. We'll just see it. First, we'll try to understand a lot of format ahead. Okay, that is known as basically NOPAT is equal to operating profit before interest and tax, and that is 1 minus tax. Like PAT, yeah, NOPAT, and that is in that you have to add interest and get one tax, reduce net of tax. That is NOPAT. But many a times what happen, in the net operating profit, there are certain adjustments which the authors thought that okay, maybe if you are reducing it from your profit and loss account, it is not acceptable. You have to make certain adjustments also. So there was a person, yeah, there's a person. If I'll just read it for once, yeah, you will get it more clear. Yeah, I'll just open it for once. Yeah. Yeah, the concept of NOBAT over here says the EVATM is a trademark of Stein, okay, Stein Stewart Company, which says that EVA is a tool to measure whose performances of the residual organization because the RI and the COC, it's okay, fine, maybe not. So EVA is to be calculated. How? You calculate net operating profit. If there is any cost of capital, you just reduce it and get the EVA. So what I do, EVA is equal to NOPAT minus COC, cost of capital. Okay. So that is this NOPAT minus K into capital. So what is that K into capital? That I will explain you WACC into capital, but don't worry. Over here, many organizations use normal profits. Baba, normal profits does not takes into account. Normal profit will only take into account equity. But we also want for cost of debt. So what we have, no pat, or we'll take like profit after tax plus interest net of tax, we will take it. We have to take that so that we can get it exactly for my debt holders also. Okay. Many times it is argued that the adoption of EVA and the performance measurements are maybe same and maybe different. So we have to consider that two ahead. So over here, as a finance charge on the capital employed is deducted from profit in EVA, profit must be before interest. But if you understand it, I am doing always like that. If you read it or if you don't read it, it will be any which way is the same. That is, at the end we have to add net of tax. So what I normally do is I take it operating profit before interest and tax. I will reduce interest from that. I get profit before tax. I reduce tax from that. I get profit after tax. Then I add interest net of tax. One minus tax, like net of tax. So I get no pat. If you want, you can just learn it. You can just learn it. Okay, you just can learn it. So now this no pat over here, but we get it. It is available for the equity and the debt holders too. Okay, yeah. This is how of the showing of the profits as if there is no debt. Okay, yeah, there can be two approaches. Start it with the operating profit, which I have it, or whatever the pat it is. See, if I started with the operating profit, which I already had it, adjusted nets, adjust the tax charges by adding interest multiplied by the tax. What I told now, please learn that and do it. If it's profit after tax or whatever it is, then also add 1 minus tax. It's the same, isn't it? It's the same what I told you. It's the same. Nothing else is to be done. Nothing else is to be done. It's the same. Okay? Easy. Yes. They have made the format. We'll just see it. We'll just have an overview. So that is what the profit is. Now, if you see, ma'am, what is all those stuff? What is all those stuff? Yes. What is all those stuff? You get no pat. You just told to add only interest fee. 1 minus tax. That's all. What is this no pat? Okay. Now, students, we need to do, I told you now, without adjustments. Now, there is a need of doing some adjustments also. So, what's the meaning of adjustments? In the question, there will be sometimes written that, okay, you are left to do some adjustments. So, we are liable to do certain adjustments in the NOPAT. In the NOPAT, certain adjustments are to be done. Like what type of adjustments, guys? When we were calculating NOPAT, there's a person who told that at times whatever expenditure you're booking now, it is not true that full expenditure is incurred in the current year. For example, the person is having a lot of concern about the non-cash expenditure. He says, let's say provision for doubtful debts if I have created. Try to understand. If I have created any provision of doubtful debts or bad debts, have I literally made any payments in cash? No, no, no. But still you are reducing it as an expenditure in your P&L account. Yes, yes, sure. So they told, if you have reduced it, please add it back again. Why? They don't want you to reduce it. They don't want you to reduce it. So they told, please add it back. Please add it back. Okay. So if it is something like non-cash expenditure, you are not supposed to reduce it. You are supposed to add it back. Then they have asked us, okay, let's say if I'm having any other non-cash expenditure, then still add it back. Because we will not give you deduction. But when you take no part, it is already deducted in your P&L account. So your profit will be less. So they told, we want it added back, we want more profits. So we any which ways have to add it back again, right? Then we have something which is known as deferred expenditure. For example, I'll just make it for adjustments now. Guys, we have three parts. First is non-cash expenditure. That is, for example, I told you now, example, provision for bad debts or doubtful debts. Bad debts. Is bad debts, am I paying cash? No, ma'am, nothing like that. So please add it back. Add it back in your P&L stuff. In your P&L stuff, please add it back, okay? In your P&L stuff, please add it back. This is a non-cash. Second is deferred expenditure, deferred revenue expenditure. So you'll be saying, ma'am, what is deferred revenue expenditure? In some or the costs which I will be seeing in the P&L stuff, for example, like this, research and development, advertisement cost, let's say training cost, let's say marketing cost. A huge amount of cost is incurred. Huge means huge. For research, we have so much of cost. If I'm putting it into P&L account, just imagine what losses you will be having it, right? So here, the person told that over here we have been analyzed that if it's a research and development, if it's an advertisement, if it's a training and marketing, if you're doing the expenditure in the current year, it's okay. But regarding this expenditure, you will get a benefits in long run also. Means today if you do the expenditure, it's fine. But in long term now, you will get the profits. Means I will get the revenue in the deferred period. Means I'll get the benefits later on also. So it's better, don't reduce the full cost, add the full cost back and only reduce as much cost as per the life of the things. For example, let's say, for example, the advertisement cost is, advertisement cost was, let's say, 5 lakhs. Okay. And I thought for 5 years, I can get the benefit. So from the profits, this 5 lakhs would already be deducted, right? So add back the advertisement cost of 5 lakhs and reduce only 1 year's advertisement expenditure of 1. So maybe it's only 4 which we have to add it. It's net 4 to add it. And this is what I'm allegedly expecting guys to know. Huh? You guys must be knowing all this stuff because your examinations are way near. And this is again the important topic which turns around to be important. Huh? So I'm expecting you to know, guys. If you don't know, please study it, concentrate, please pay the concentration. So here I will add back all the stuff and reduce only my amortized part. Amortize means how much can I assume it in the year, in 1 year, how much expenditure is allowed, that much I will reduce it. Third is depreciation. So what the person told, like if you have like reduced depreciation, accounting depreciation, add back. Means your accounting depreciation is to be added back and you find your economic depreciation and subtract that. Means what is economic depreciation? Economic depreciation means, like for example, this is my asset. Okay, I'll just formulate it once because I don't want to like confuse you. Let's say about depreciation. Okay, about depreciation. This is my normal assets, non-current assets of let's say 1 lakh. Okay, I thought maybe the life is let's say 10 years. So in my P&L stuff, I would have depreciated at the rate of let's say 10K. Okay, this would be my expenditure. To get the profit, I would have deducted 10K. Yeah, cool. But as per the knowledge, your economic depreciation means the asset which was worth 1 lakh, it had a useful capacity of manufacturing, let's say 20K products. Okay, 20,000 products. Okay, understood, 20K products. Let's say in the current year, I manufacturing 20,000 units is it's the limit. Okay, I manufactured let's say 5,000 units. Oh my god. So 25% of the asset I have already utilized. So if 25% I would have utilized, so my depreciation, economic depreciation should be cost into 25% usage, which is 25,000. So instead of reducing 10,000, I would have reduced 25. So please reduce 25. And by mistake, if you have reduced 10, add that 10. Add that 10. Yes, guys, getting it? Yes. So this is what the concepts are. This is what certain adjustments you have to make in your P&L statements. Yes. I hope you guys are getting it. Yes. Clear up till here. Yeah, for sure. No doubt. Yeah. So this is what we have to do it for the NOPAT also. Yeah. So if you read it now, you will get to know what things I did it over here. It's first, in the calculation of summary of profits, I get some NOPAT. I will add a what? If I am having accounting depreciation, which I already deducted it, means my normal depreciation I would have deducted. Normal depreciation would have been deducted. Normal advertisement cost would have been deducted. Normal provisions I would have deducted. Normal uh, research and development cost I would have deducted. Normal training I would have deducted. All this if you have deducted it, add back. Add back depreciation, add back increase in provision, add back bad debts, Add back increase in provision. You have to check previous year what was the situation, current year what's the situation. If it is increase, add back. Add back research and development, add back training. But what to deduct? If this is a stuff, research and training and all, let's say the life is 4 years. Divide it by 4 years. What you get it for year 1, only that much is allowed. So just read it. So what I will reduce it? Economic depreciation. Amortization of advertisement research training cost. Reduce it. Then relief on interest means, what was it? You remember? Initially what I did it, I normally would do, I normally reduce first interest and then I add it back. They have did it in the reverse position. They have multiplied it. It's better to don't do like this. If you want, you do like that. No pat. When you are doing no pat, initially you have already reduced interest. You have reduced. So add interest net of tax. You will get one and the same effect. Okay. And then if it is any decrease in provision, reduce it. So all this stuff is also to be added it and accounted it. So these are the maximum adjustments which you have to do. If you learn this, your 50% of the work is done. If 50% or maybe 80% of the work is done. If you understand this, if you learn this, okay? I hope it's clear. I hope it's clear. So till now in the EVA, we have just till now we have been finding till NOPAT only. But what is K and what is capital? For understanding that, guys, we have to go ahead and find it out. The adjustments for over here, everything is same. Like whatever adjustments I have explained you about what's the meaning of economic profit. Yeah, what's the meaning of accounting profit is given. If you have time, please read it. Okay, everything is same. Okay. It's the same. It's the same. So yeah, what are the non-cash expenditures? Okay, if you can see over here, investments, adjustments, accounting adjustments. Then many adjustments are made for accounting adjustments, like for the cash basis. So if we have any non-cash basis, we are adding it. Yeah. Research and staff training expenses as per International Accounting Standard 38 it is. We put it P&L account, but it's better to like amortize it over the period that way. Yes, cool. Okay, I think like we are very cool with it. It's the same. Okay. Now allowances and provisions, same non-cash expenditure. So it's better to add it back, non-cash expenditure. If it's allowances and provision, add it back. Yeah, add it back to the capital employed also and the stuff also. So if it's a cash expenditure, tax expenses, so taxes are to be deducted and we get the summary. But this line is the most important. When I find it out, what the NOPAT minus WACC into K, or like the weights, or like WACC, if I just write it, weighted average cost of capital. So we have what, guys? WACC, weighted average cost of capital. We have to find out what are the weights. Weighted of equity into cost of equity plus weightage of debt into cost of debt. And weights or whatever the capital I'm finding it out, capital employed I'm finding it out. Which capital I have to take? Which capital I have to take? Like how much is my equity amount? What is my debt amount? Which days? So we have to always calculate on the day one. That is capital employed is taken on the start of the year. Please, people will do what? People will take on 31st December. No. If you want to take 31st December, please take previous year's 31st December. That will be 1st Jan for the current year. So we have to take the opening statement and not the P&L of the previous year. No, not the P&L, not the capital employed of the previous situation. No. Year end cannot be taken. We always have to take for the opening balance only. I hope we are getting it clear. Yes, definitely. Yeah, super. Is it okay? Is it acceptable? Yes. So over here, there are certain adjustments which is given, which we can read it for once. Okay. There is certain changes to the P&L statement also. There is certain changes to the capital employed also. Now this is important. If I'm having any advertisement research and all cost, I normally add it back. Interest I increase in my profit. If it's any economic depreciation means economic depreciation, I will deduct economic depreciation, but normal depreciation I will add it. If there is any amortization and all, I will reduce it. But what to capital employed? So capital employed means how much capital you are having it on day one. on day one of the current year. So if in the previous year, let's say your balance sheet, if they're asking about the balance sheet, 31st 12 22 will be the balance sheet, and I'll take it on 1st 2023. So on that date, yeah, if you're having any operating lease, please add it back, or the lease payments and deduct only depreciation on the assets. Yes. If you have any provision, if the provision has increased, add back. If the provision has decreased, less it from the profit. But add back the value of provision to capital employed also, because that provisions, what is the entry? Expense account debit to provision. So provision also, financial statements, financial position is also going to get impacted, not just P&L. So please make the adjustments, necessary adjustments are to be made. Okay. And non-cash expenses, please add it back and show it in the retained earnings. That's all. That's all. So now we are talking to you about the WACC. That is weighted average. It's known as weighted average cost of capital. Okay, cost of capital. Okay. So we considered it as WACC is equal to WE into KE plus WD into KD. So what is WD? What's weightage of equity? What's the weight of equity? Weight of equity means equity consists of what, guys? Equity plus reserve and surplus. And when it is the cost of capital, the capital employed, it consists of equity, reserve and surplus, and all the long-term debt also, plus the long-term debt also. Long-term debt. If I say, let's say the company is having the equity of, let's say, 1 lakh, reserve and surplus of, let's say, 0.5K, 0.50 lakhs, like 50 lakhs. Yeah, I'll just write it like that. It's 1 lakh. Yeah, it's 50K. Let's say I'm telling the long-term debt is also 50K. So maybe my total company's capital employed is, let's say, 2 lakhs. So what is the weight? What is the weight? So is it not, if I consider this, it's 1.5 and 0.5. So maybe it is not 75 is to 25 percentage. So do 1 lakh 50 divided by 2 lakhs. Are you getting 75 percentage weight is there? So this is the total, huh? For equity, weighted of equity, this is what? Weightage of equity into capital of equity, and this is weighted of debt. So what's the weight of equity? So it's 75 percentage. So you can write 75 percentage into question me, it will be given what's the weight of equity? What's the weight or what's the cost of equity? Maybe the cost of equity is, let's say, 12 percentage, plus the weight of debt will be 25 percentage into, let's say, the cost of debt is given in the question 10 percentage, and let's say the tax rate is 30 percentage. So I'll do 10 minus 30 percentage, which comes to be 7 percentage, and we can calculate the weighted average cost of capital also. Any capital is to be calculated on the day one itself, and if required, necessary adjustments are to be made in accordingly. So yes, students, I have taken up a very high weight. So if you can read it over here, WACC means over here KE is what? It's a return on equity, which will be provided you in the question. Yeah. Then we have E upon ED means what? What's the equity portion? In the previous question, it was equity plus reserve and surplus, which is equal to 1 lakh plus 50K, which was equal to 1.5. And the long-term debt was, let's say, 0.5. That is 0.5. So my total was 2. So can I take 1.5 divided by 2 into, let's say, the KE is given in the question, let's say 12 percentage, and KD is given in the question. 1 minus tax is, let's say, 10 percentage minus 1 by tax, 1 minus 30 percentage is equal to 7 percentage. So I can take 1.5 into 2 divided by 2 for equity multiplied by equity's portion of 12 percentage plus 0.5 divided by 2 into 7 percentage. And I can get the cost of capital. And I know this is all you guys already know it. Yes, clear? Clear. So it's very important to take what? The beginning of the financial year and not the end. Okay, not the end. Yeah, so these are certain factors which we have to consider it. And if my EVA is positive, no PAT, minus KC, okay, E. If it's positive, go ahead. Otherwise not, please don't go ahead. If your EVA is positive, please go ahead. Otherwise, don't go ahead. Yeah. So EVA helps us to make the investment decisions, obviously. it is a better position to understand like the company is working well or not. And this is what I just wanted you guys to understand about the EVA concepts also. So I hope you understand EVA also. Yeah, let's just take a break of 5 minutes and we'll be resuming back with the concept of transfer pricing. For students, if you want it, we can like solve a lot of sums. If like see students, we have an ACCA study hub, we have ACCA resources where you get so many beautiful questions. So please do practice. Please do practice questions from EVA also. Like I really want you guys to practice the questions from EVA also. Okay. So we'll get a huge questions. So please do practice and we'll be just resuming it back within 2 minutes and we'll be doing it about the transfer pricing also. So yes, students, welcome back all of you. Now, let's start with again the most important topic, which is known as transfer pricing. So yeah, what is the meaning of transfer pricing? If I just go ahead with the word transfer pricing means, for example, as we have already studied about certain divisions, right? So let's say there is one division, again the same one, the bottle one. Yeah, the bottle manufacturing division wants to sell the bottle. So there can be a kiosk, like whether at what price the bottle manufacturing division is going to sell the bottles to the other division, right? They can either sell it at cost, they can either sell it at profit also, right? So over here, can there be a situation where there can be some manipulation? Yes, ma'am. So you will say that, ma'am, there can be a situation where like there are two divisions. So maybe the divisions are not in the same country, maybe in the different tax country. So there is always a need to have an arm's length price. Okay, that's fine. That's fine. I'm not asking about that. I want to know, can there be a situation, can there be a problem to channelize, to find out what is the price that is known as transfer price? At what price should the transfer happen? Yes, students. So with this, we'll just understand what's the meaning of transfer price. So I'll just give you a brief out. What is the situation traditionally and what is the situation in the current period now? So traditionally and new system. Okay. Traditionally, what used to happen? Let's say there is a company. There are two or three divisions. Let's say three divisions were there. Okay. Division A, Division B, Division C. Let's say Division A has to make something and send it to Division B. Division B has to make something and send it to Division C. So what they used to do is, they used to have whatever the cost of making unit A. Yeah, like over here, let's say they are manufacturing some raw material X that has to be sold to Division B. They will be processing it, and maybe then they'll be selling it to Division C, sending it to Division C, and sending it to Division C, and Division C will sell in the market. So what they were doing, whatever was the cost of raw material at cost, they were just sending it. So people didn't had any enthusiasm. So they were knowing like people will get their salary. That's all. How much unit they make, what they don't make. It's least concern. But today to make it very competitive, to make it very competitive, in the new system it's A, B and C. A is making some raw material. Let's say the bottle. They will sell it to B, not at cost. Cost plus some portion of profit margin. Yes. B will, let's say, make it, let's say he'll fill the Coca-Cola, purchase the bottles, and maybe he'll sell it to C division for packaging stuff and all. So for that also he'll add some profit. Now C will sell it to outsider by giving some profits, so that there is a competition. With competition, I'll say, Kacha, the company will say, whichsoever departments or whichsoever division makes the highest sales and highest profit will earn. But that never means that to earn more profits, I am adding on anything like any percentage of profit. No, no, no. So that is what we need to understand. Like, is it better for the, let's say, division B to purchase the bottle from division A, or it's better to purchase from outside? So yes, that is what we are going to understand the meaning of transfer pricing. So transfer pricing helps us to get a healthy competition between divisions, as we see the divisions also in a better position as a profit center and not just the cost center. I'll just give you one thing. You need to understand it and then we can go ahead. For example, let's say there are division A and division B only. Over here it's manufacturing bottle and here some coke. Okay. For example, if bottle is normally sold in the market at a rate of let's say $10 and I told division A, okay, please, division B told, okay, you have to send me also. Please, I want, let's say, division A has manufactured, let's say, 1 lakh bottles. Okay, 1 lakh bottles. And division B also want 1 lakh bottles, for example. So division B told, okay, please give me 1 lakh bottles. So division A told, okay, Baba, I'll give you a $10. If he told, okay, I'll give you a $10, will be the selling price. Will division B purchase from division A? I am telling you that division A also sells at $10, and if B went to the market and B found out, okay, I get in $10 only. If B gets in $10 only, see, today the people are very bad. Today the people are very competitive. Company B will never purchase from A. Why? He'll feel na, if I'm purchasing from A, the capacity, the target of A's selling is already finished. A is getting profits. Why will I give A profit? Why will my other division work well? I will purchase it from outside only. He is not giving me any benefits. Why will I give him benefit? This is what really happens. But if A don't give a $10, if A sells at $9, maybe now division B purchases everything from from division A. So that is what we have to find out. At what price the transfer is going to take place. Is it $10? Is it $9? Or like what? So that is what we are going to understand it. So yes, over here, if you read it, yeah, this is what our theory is. The objective is to describe and address the impact of transfer pricing. So what are we going to learn? Some methods are there over here. Then we have an opportunity cost, which is important. What can be the price for selling division, buying division? Then we have some approaches, which are very easy, and some multinational company situation also. So transfer pricing means it's the price at which the goods and services are transferred from one division to another division or from one company to another company also. So yes, this is very, very, very easy, which we understood it. Okay. So before I go towards the transfer pricing method and all, which is very easy, let us understand first of all what could be the transfer pricing approach. And we'll directly jump into the transfer price, like who is going to set the prices for. Okay, who is going to set the prices for? Students, like I'm telling you, legitly it is important, so please try to understand it. Like we'll go it very slowly. Okay, I'll explain you with the concepts. No, I'll explain you with the question and then we will read the concepts. So students, like for that now, let me make a lot of blank slides for us. Okay, so I have made like 4-5 slides for sure. I have put up a lot of blank slides for us. Okay, now let's say this is ABC company. Oh, that is ABC company. ABC company. Okay, in ABC company, let's say there are two divisions, division A and division B. Just try to understand it very easily. Okay, if you understood this, you can solve any question. You can, I'm promising you that you can solve any question. Okay. So yeah, for that we have to like pay concentration. Yeah. So for that, yeah, we'll also understand it very well. Okay. So this is my ABC company, my company as a whole, in which there are two divisions, division A and division B. Let's say division A manufactures a component. It manufactures a component which is being used by division B. Let's say division A manufactures a component for calculator and division B manufactures the whole calculator. Okay, they manufacture the calculator only. Okay. To manufacture the component, division A normally have a selling price to outsiders at $60. At $60 means if you see, if normal component is also being sold, yeah, the normal component can also be sold. So it can be sold to the market at $60. Do you think the division A would have actually variable cost of 60 only? No, ma'am. There will be some other cost. Let's say for division A, the variable cost would have been let's say 45. Okay. Okay. Now I'm highlighting one thing with blue color that is also very important. Okay. For example, the capacity of A to manufacture the component is, let's say, 10,000 units. Okay, this much stuff is given. Let's say when I go to the division B requires calculator, and for every one calculator, he requires 1 unit of the component also. Let's say, okay. So if I am talking to you about the division B, then normally this calculator is sold in the market at the rate of $88. So the selling price of the calculator is given $88. Yeah, see, division B also have to do some cost because see, component maybe he can buy, but he has to do some other cost, right? So he has to manufacture some other cost. So division B's own variable cost, it's let's say $30. Okay. And division B wants 10,000 units. Units, no, sorry, 10,000 components. Okay, 10,000 components from division A. Means this many components division B wanted. Tell me, what will be the minimum transfer price? Means what will be the minimum transfer price? So over here, we will be learning minimum transfer price. Means at what value should A sell the component to B? So for that you have to see, if A is not having any sales, means if A is having no sales, like A will find out. If B, A will sit and think, if B would have not purchased anything from me, I would not be able to make any sales, right? Yeah. Means if B would have not came and ordered anything from me, I would have been no sales. I would have do no sales because my capacity is 10,000. Let's say my outside demand is zero. Are bapre. If your outside demand is zero, that means if B would have not requested, you would have got no sales, right? Yes. Then your minimum transfer price is what will be only your variable cost. Will be only your variable cost. Because if B would have also not came, then you would have any which ways not got any profit. Yeah, you would have not got any profit. So please sell B at least at the variable cost of 45. At least sell at variable cost of 45. Then you can sell it from 45 to 60. That is fine. Any price. But minimum, we have to find out the minimum transfer price. So minimum transfer price can be 45. Why? Because if I ask you, do division A have any sort of opportunity loss? No loss. Why loss? No loss, no opportunity loss. It's something like at least they are getting the variable cost recovered. Yes. So this is their minimum transfer price. Now, let us understand the same question, and I'll make it very easily. Just try to get it, okay? For understanding the minimum transfer price for division A, we have to find it out. Let's say we know that the capacity is how much? The capacity of the company is to produce only 10,000 units. Okay. I'm telling you, they have outside demand in 3 cases. Yeah. They have outside demand. What is the outside demand? In case 1, division A is having 8,000 demand. Oh, outside. In case 2, they are having, let's say, 9,000 units demand. And in third case, they have 10,000 units demand from outside. Okay. If I have asked you, okay, please tell me how many components division B is asking us to find out. So let's say division B has asked us, division B told, okay, division B wants a minimum of, let's say, 2,000 units. Okay. 2,000 units division B wants. And it is a hierarchy that if you, a company, like there are 2 divisions set up. So first of all, chahe to jo bhi ho means whatsoever the situation is, division A has to cater the needs for division B because division A is meant for catering the division B, right? It's one group. So they cannot do like that, we will sell it to outsiders, we will not sell insiders. No, no, no. They have to first satisfy. So it's written, okay, please, division A has to first satisfy the demands of division B, and plus if they have any spare capacity, they can sell it to outside parties. So okay, this is a situation. Okay, I'll go ahead. Now, if this is your outside demand, so can you tell me what is the spare capacity? So yeah, the spare capacity is 2,000 components, 1,000 components, and 0 component. Okay. Yeah, this is a situation which is there. Now, if I tell you, yeah, if first of all, division A will satisfy 2,000. So what will be the minimum transfer price? Minimum transfer price will be, if you see it, there is a formula. But maybe if you understand the formula, it's well and good. If you don't, still it's fine. Just give me one second. Yeah. Okay. If you learn the formula, it's well and good. Otherwise, there is no need to learn the formula also. It's very cool. So divisional transfer price will be minimum what? So you have to see what is the minimum transfer price they're going to get. Will they get 60? Pakka? Ma'am, if they sell in the market, they get 60. They get the profit of 15. Profit means the opportunity gain of 15. But if they don't have any demand in the market, for 2000, they can sell at the minimum cost. They can sell at the minimum cost only. Yeah, they can sell at the minimum cost only. So yes, students, the minimum transfer price is something that they are not going to get any sales outside. So maximum they can sell 8,000. So their capacity is, let's say, 10,000. So first they can sell it to 2,000 to their company, to the other division. So minimum they would want to cover their cost. That is minimum for 2,000 they will cover variable cost. And the formula is variable cost plus opportunity loss. So is there any opportunity loss if I was not able to make any sales to outside party? No, no, no. I had demand of 8,000. I catered it also. So my variable cost is 45. So your minimum transfer price will be 45. Clear? Yes. Now, if you understand this, okay, I'll just make it very small because I have to formulate other things also. Yeah. Okay. Now, just think of the second question and give me the answer if you can get it very superb. Yeah, very superb. Just try to analyze it. If I'm having, let's say, 9,000 units, which they have told okay, you have a demand of 9,000. Oh, wow. Means if I have a demand outside 9,000, that means only 1,000 I'm having spare. So for 9,000, if I want, I can sell and get 60 here. But for 1,000 only, I'll get 45. So you'll say, ma'am, not allowed. You have to anyhow first satisfy your internal demand. Oh my God. So internally, I have to sell 2,000. So over here, first this 1,000, I will sell this 1,000 unit, I'll sell it at the transfer price of 45. Agreed? Yes. Are you getting it what I mean to say? Yes. Are you getting it what I mean to say over here? So first of all, you have to understand at what value will you satisfy it. For this 1000, which is your spare capacity, for this 1000, which is your spare capacity, your variable cost plus opportunity loss is nothing. So your cost will be 45 only. But for remaining here, from here 1000, if you reduce it units, you have variable cost plus opportunity loss of 15, opportunity loss and 45 cost. So here you have to make a selling price of transfer price of 60. Means even if you sell to inside, you will say, Arey, I will charge profit also because for you, I have sacrificed my profit. Yes. So for remaining 1000 units, you can charge 60. So if I say what will be the average? So you can say for initial 1000, for initial this 1000, you will charge 45. For remaining 1000, you will charge 60. So 1000 into 45 plus remaining 1000 into 60 divided by 2000 units. If you do it, you get nearly around 52.5 as your transfer price. So if the demand is 9000 in the external market, your transfer pricing value will be minimum 52.5 per unit. Agreed? Last but not the least, just imagine you have no spare capacity, but still you have to satisfy how much? You have to still satisfy 2000 to your internal. So out of here only you will see. Means you will reduce 2000 sales to outsiders. So you will the full charge. For 2000 units, I will charge my selling price of how much or my transfer price of how much? What will be my transfer price? Variable cost plus opportunity loss. 45 plus 15. Is it coming to 60? Yes. So it will be now, if you see this, for initial where you have spare capacity, it will be like 45. If you have some only spare capacity for that 45 and remaining 60, so your average will be like 52.5. And over here, when it is fully occupied, it will be 60. And this is nothing other than known as your minimum transfer price. So yes, guys, this is what we normally learn about the MLP, minimum transfer price, MTP. Okay, minimum transfer price, which like the transferor has to find it out. If this is the minimum transfer price, what is the maximum transfer price then? Means if I just continue the question, what is the maximum transfer price? So maximum, if I see, we have to find out what will the division B maximum pay. Oh, what will be the division B maximum good to pay? So you have to go and find here for division B. Achha, what have they given in the question? If division B over here, it is a situation like I'm just copying it over here. If division B is there, division B if sells in the market, he can sell the calculator at the rate of 88, right? He can sell the calculator at the rate of 88. Yeah. So, oh, I'm so sorry. Uh-huh. Okay, it's okay. Maybe okay, it's over here now. With whatever it was with red, I just deleted it. Okay, so that otherwise it's for division B. For division B, they were solely selling the calculator for let's say 88 in the outside market. Division B was having its own cost also. So when we see the maximum transfer price for division B, we will understand that if division B can sell the calculator to outside party at 88, if he can sell the division calculator of 88, yeah, he also is having its own cost. Own cost is let's say $30. Yeah, so his remaining cost is 58. So maximum he will be ready to pay 50 only. Maximum he'll be ready to pay 58 only for the transfer price. That means if you are purchasing at the rate of 45. So over here, if the spare capacity is there and if the division A sells at 45, he'll be happy. If there was spare capacity, the minimum transfer price was in the first case of 2000 spare capacity was let's say 45. Then you remember 9000 was external demand. At the time they made a sale of 52.5 as a transfer price average. And when the external outside sale was 10,000, he made a selling price of or transfer price of 60. So over here, if I see, my person will not at all be happy. My person will not at all be happy, like to pay more than this. So 60, if B, if I quote division A quote 60, he will say no, out. So divisions B will never purchase at 60. Maybe 52 point in between, if any price is quote, maybe he'll be agreeing. Maybe he'll be agreeing. But what if I say this is a maximum price which he can pay, and if he go and find in the market, he can also purchase the same component at the rate of, let's say, $50. Oh my god, then he will not at all be accepting to take in this also. So maybe this or 50 will be his maximum transfer price. That's all. That's all. I hope you guys understood it. The meaning of minimum transfer price and maximum transfer price. So here, students, we have understood a lot of concepts of transfer pricing, then divisional transfer pricing, and a lot of EVA, ROI. So I want you guys to really practice a lot of sums, practice a lot of concepts, and yeah, we can go ahead with that. So I hope you guys would have understood it, and yeah, thank you. We'll be meeting in the next sessions. And yeah, guys, I'm requesting you, if you guys have any sort of doubts, you can just message me on the chat. Like whenever, if you feel like questions, you can put it up. Obviously, we have an Instagram ID, we have an we have chats, obviously we have Telegram ID. So yeah, we can just message, and always the Lakshya team is there to help us. Students, for any further query, you can just contact me. And if you want any other further chapters videos, so you can just always tell me. Okay? Thank you and all the best. I hope this video would have been helpful for you guys. Yes, thank you.